The 2026 housing market is finally thawing. Inventory levels are springing back to around 5 months of supply, and mortgage rates have dipped below the 6.5% peak. On paper, this is the most balanced housing market in years. Many buyers are waiting for 3% interest rates and a 20% price drop. However, history shows that achieving both requires a severe economic collapse, the kind of crisis that usually threatens employment stability along with home prices. While national figures show stabilization, the local reality remains difficult. Home affordability has improved only slightly. A median income earner faces a significant financial climb to secure a standard home in this environment. In 2026, the buying strategy involves a trade-off between market timing and personal life readiness. Success no longer depends on surviving a chaotic bidding war, but instead on evaluating your individual financial health. Real estate moves slowly, and conditions vary by zip code. Because the perfect time to buy is usually only obvious in hindsight, the only manageable factor in your control is your own financial stability. To afford a median-priced new home of $413,595, a household needs a minimum income of $121,674. At a 6% rate, 65% of households, roughly 88.2 million, are excluded from the market. Furthermore, a $1,000 price increase disqualifies an additional 156,405 households. Observe the housing affordability pyramid, categorizing maximum home prices by income group. The base is heavily concentrated, with 47.5 million households limited to homes priced under $200,000. A segment that has largely disappeared from the new construction market. For many Americans, this barrier to entry is structural. Expecting prices to drop significantly to meet average incomes is a bet against a decade of underbuilding and a persistent supply gap. A common strategy involves waiting for the Federal Reserve to cut interest rates. The goal is to increase individual borrowing power enough to make the monthly payments work. The market responds sharply to these changes. If rates drop by 0.25%, from 6.25% down to 6%, the national pool of qualified buyers expands. That small decline allows over 1.4 million additional households to qualify for a median-priced home. This surge in demand creates a rate trap. While your estimated monthly payment may decrease, you are now competing against 1.4 million new buyers. This influx historically leads to price spikes that can neutralize your interest rate savings. Conversely, a balanced market offers a different advantage. When demand is steady, buyers have the leverage to negotiate credits and repairs before a potential rate drop triggers a buying frenzy. You often have more negotiating power when borrowing costs are high enough to keep the crowd sidelined. Waiting for a perceived perfect rate typically means trading that leverage for a spot in a competitive bidding war. Some buyers choose to lower their rate immediately by paying mortgage points. This involves an upfront fee, usually 1% of the loan, to permanently reduce the interest rate by about 0.25%. This is a cash trade-off. Spending $4,000 at closing to save $133 a month requires exactly 30 months of payments just to break even on the initial investment. This involves refinance risk. If market rates drop and you refinance before that 30-month mark, the money spent on points is a total loss. However, points provide a lifestyle benefit for those committed to a long-term horizon. Securing a lower locked-in cost offers peace of mind for buyers staying put for 5 to 10 years. Mortgage points represent a wager on interest rate stability. They provide definitive savings over a decade, provided you are willing to sacrifice immediate liquidity at the start of the loan. Maintaining liquidity is useful because the 2026 market favors the prepared. Homes are currently sitting for a median of 67 days, the longest stretch in nearly 7 years. This slowdown creates real opportunity. Over 62% of buyers in the recent cycle received a price discount or a financial concession from the seller. These concessions allow you to use seller funds to cover closing costs or buy down your rate. This protects your own savings while still lowering your monthly obligation. Do not use this environment to overextend your budget. Avoid the refinance gamble, entering a mortgage you cannot afford today based on the assumption that a future rate cut will save you. You may hear the phrase, marry the house and date the rate, but that only works if the initial payment is one you can comfortably sustain for several years. Your primary tool in 2026 is time. A balanced market allows you to conduct thorough inspections, review your budget, and walk away from a deal that doesn't meet your criteria. Some argue that renting a modest apartment and investing the difference in the stock market builds more wealth than buying a house. The math for this strategy is sound, but it rarely accounts for human behavior. Most renters do not consistently invest that leftover cash every month for decades. A mortgage functions as a forced savings plan. Every principal payment builds net worth, which helps explain why homeowners historically have a median net worth 40 times higher than that of renters. To test your readiness, try the 90-day training. Save the exact difference between your current rent and a future mortgage payment for 3 months. Homeownership builds wealth because it automates financial discipline. If you cannot pass the 90-day test, you may need more time to prepare for the responsibility. To make an objective decision, use the 2026 Buyer Matrix. It begins with one question: do you have job and location stability for the next 5 years? If you lack stability, high transaction costs will likely erase your equity gains. In that case, renting is the correct financial move. If you have stability, the second gate asks, will you have emergency cash reserves after closing? Entering a mortgage with zero remaining cash turns a single roof leak into a financial crisis. If you lack reserves, keep saving. If you have the cash, the final gate is affordability. Is the payment comfortable today without a refinance? If you pass all 3 gates, you have an advantage in this balanced market. You can stop attempting to time the market and focus on finding the right house. Renting represents a period of patience. However, waiting while your finances and the market data align can become a costly mistake. Individual preparation defines your success in 2026 more than any attempt to find a perfect market.